Thank you for joining us at FutureMoneyTrends.com. I'm here with Jordan Roy-Byrne. He's with the Daily Gold. It's a newsletter you can subscribe to. He has a free and paid membership if you're looking to get special fundamental and technical analysis on specific gold and silver companies. Thanks for joining us.
Daniel, thanks for having me. It's a real pleasure and kind of you to invite me.
Thanks. I want to start off with basically people are looking at the gold market. We had that all-time high last year, and of course the big, move with silver. What's your overall thoughts of the gold and silver market right now with the actual physical precious metals prices?
Well, it's interesting. The physical, up until earlier this week, I'd say until Monday or Tuesday, the mining equities were holding up much better than the metals, and usually that's a very good sign. However, in the last 3 or 4 trading days, the equities have fallen to new lows in this correction, while the metals have not taken out new lows. So, we're in a interesting period right now, I believe, because I believe we did in the equities, we had a major bottom in May, and it was a double bottom. We had the double bottom in the summer, and we've come back a little farther than I've expected. So, looking at, I know you asked about the metals, but I always focus on the equities because I believe they lead the metals. And the equities, we have seen some short-term technical damage. So I do believe that on Friday we probably made a short-term bottom, but because of the technical damage, that means it's going to take time to repair the momentum in these markets. And so even though your long-term risk-reward is pretty good right now, I wouldn't have high expectations over the next month or two. And in regards to the metals, looking at silver, I do believe they've bottomed. Silver hit a bottom at 26, and it remains to be seen whether silver will hold the recent low, I think just below 31 or $30 or $31 an ounce. So we're kind of treading water right now, but I still believe that we hit a major bottom in this cycle, and so generally speaking, very positive. But like I said, over the next month or so, you probably want to temper your expectations. It's going to take some time for these markets to build up that momentum again that they're going to need when they attack the recent highs and make an attempt to break out. When
you said the equities have led the metals, that really hasn't been the case though for the past few years. So if you could expand on that. They've been a disaster for a lot of people investing in the mining stocks. The gold and silver have done very well for people though.
Yeah, that's absolutely true. If you go back to 2011, the equities, even most equities peaked at the end of December, and then you had some that peaked in the first quarter of 2011. However, in the last couple months, the equities, as we know, they were showing a lot more strength even during most of this correction, and so that's a good sign. It usually bodes well. It means the market is going to start turning up again, and the metals will follow the equities. But in regards to the equities, it's so interesting because I think the nature of the business, looking at the large caps, which make up the HUI or the GDX, those companies, when you get to be a certain size, it kind of becomes mathematically and geologically impossible to continue to grow. So I think just given the nature of the industry, when you become a certain size, you become that large. Over time, it's very difficult to grow. And another point on that I'd make is, well, several other points, and I'll do it quickly. But the first point is, you hear a lot of fund managers who are attacking the gold stocks. The large ones are the only ones that the fund managers can buy. The junior producers here that you and I invest in, we speculate in, fund managers cannot buy those because they just have too much money. So they can only buy the top dogs. And as we just said, the top dogs are the ones that, because of just pure mathematics and geology, it's just a difficult business to grow from and generate returns. So, looking at those things, it's just so interesting. There's so many different companies that make up the gold stock universe, and then you have the mid tiers and the juniors. And as far as the junior explorers, they do best when gold breaks out to a new high. So the question would be, okay, Jordan, well, when do we want to buy those? Well, the old high is 1900. We know that most of the resistance is at 1800. So looking at that, probably when we see gold break above 1800, then a lot of the juniors that are here, a lot of the depressed explorers, they'll start to get a bid because that's what's happened in the past. Every time gold has been close to breaking out and then did break out to a new all-time high, that has been the time that the juniors, the explorers, have started to outperform. So in regards to those, people are just going to have to be a little bit more patient.
You think it's a good indicator that a lot of the people now have just accepted the fact that the mining stocks have been horrible investments? A lot of people talk down on them. Even talking to some of the IR people, they're like, oh, everybody's chart kind of looks the same. It looks like if you were going to go skiing or something, you definitely want to try that mountain because it's got a pretty steep curve. So is that kind of the indicator that's like, hey, it's rough because everybody keeps saying it's a bottom every year. Last 2-3 years, it's a bottom. This is it. This is it. And, I'm here at the Resource Show. It's pretty light, pretty thin crowd. And what's really strange is even talking to the industry people, they're quite bearish.
Well, it is a contrary indicator. And not to get into my speech, but you look at the way bull markets and equities, we're just talking about the gold stocks, but if you look at the way bull markets and equities develop, how do we get into that bubble phase? Well, before that bubble phase, that last 5 or 6 years, there's kind of a wall of worry phase. And it sets up for the bubble phase because you have companies are still making money, but people don't buy the stock, so the valuations come down. In addition to that, as you're talking about, the sentiment becomes very favorable from a contrary perspective, because what you're looking at is only the real believers, guys like you and me, are still in this market while the hot money is all gone. So you have valuations that are favorable, you have sentiment that's improving, and so assuming we get the metals breaking out to new highs, and we're not going to see price pressure from oil because oil looks bearish to me as far as the margins of producers. I mean, looking at all those things, those are kind of the catalysts that could really take this market quite a bit higher. Of course, nobody can predict the future, but I'm just trying to lay out, this is a possibility of what can happen. Look at how we're setting up. And so I do agree with you. I mean, from a contrary perspective, things look pretty good.
When you look at the volume of the overall stock market, which has been very light, and then you have some macroeconomic trends, national debt, the Federal Reserve's quantitative easing policies. It's all inflationary when you first think about it. But then are you also concerned about, it doesn't matter how good of a company you own, there could be some type of deflationary shock to the system. Are you concerned for that? And if you were to say I'm 20% concerned about it, I mean, what percentage as far as concern is like there could be something bigger than 2008 looming out there?
Well, that could be a conversation for a whole nother interview, but I don't see that because when you have a big crash like that, I mean, we have to remember there was a huge amount of malinvestment out there. When you have that kind of crash and decline, it liquidates everything. It liquidates so many things. I mean, like we saw in '74, like we saw in '87, for example. But if you go back to the '70s. Looking at that, after 74, from 76 to 82, the S&P, I believe, had a 20% correction and then a 25% correction before the next bull market started. So we've already had 2 significant recessions in the last 8, 9, 10 years or so. And so looking at that, the companies that are still here and now, they've survived a lot of pain and they're in better shape. Now, I'm not saying we're out of the woods yet, but I'm saying, we're probably going to have at least another recession, maybe 2 before the end of this cycle. But what I am saying is if you look at history, when you kind of get to the end, we're in the second half of this secular bear market. When you get to the second half and the end of it, you've already had the 2 strong bear markets. History tells us that the next few will not be as dire as they were. Like I said, if you look at the S&P in the 70s, the last 2 were 20% and 25%. I mean, and as far as deflation, I don't believe in economic deflation. I believe in market deflation because the economics, I mean, that debate never gets you anywhere. Let's talk about the markets. If you're a market deflationist, you're bullish on bonds, which bonds look good. I think bonds are going to break to a new all-time high, and they still have room to move, before that bubble top. So I like, in terms of inflation, deflation, let's focus on the markets. I mean, are bonds looking bullish or commodities looking bullish or bearish? I mean, I think that's where we really need to look at. And so as I said, looking at those things, I think bonds still have some room to run. I think commodities, in particular the CCI, did make a major bottom in May, I think around 500, but I think we're going to retest that low. So commodities as a group, not precious metals, but looking at the other commodities, they still have some more downside. So I know that's a long answer, but that's kind of how I see things as far as inflation, deflation. You got to focus on the markets, focus on what bonds are doing, focus on what commodities are doing.
Jordan, what's your forecast for 2013 specifically for the gold and silver equities?
That's an excellent question, but I haven't begun working on my forecast yet. It's hard to say because we have seen a lot of technical damage looking at the equities in the last couple of years, or last couple of days, I should say. But one thing I will say, in regards to the metals, looking at silver, as you know, had that huge move to 50. When you have that type of move from 8 to 50 in a couple of years, it's going to take a long time to correct that. I mean, you go back to the 70s, silver was consolidating, I believe, for 3 or 4 years before it had that final blow-off. Now, I'm not saying it's going to take 3 or 4 years, but you and I, we know that when silver hit 50, it was going to be done for at least a year, maybe even 2 years. So I believe we have hit a bottom there, but we're still digesting that huge move from 8 to 50. And in regards to gold, I think you could say the realistic worst-case scenario is gold remains in a consolidation from 1550 to 1800 or 1600 to 1900. I think that's realistic worst cases. Maybe gold consolidates for a long time, but that long term, that would be bullish, because if gold is consolidating for 2+ years, it's going to have a lot of power when it makes that final breakout. So I'm not, again, I haven't done the forecast yet. There's a lot of things I got to look at, but I don't see new lows. I would say maybe the realistic worst case is we see a longer consolidation, and that could be the way it is with the equities. We did make that strong double bottom, and perhaps the equities kind of consolidate, or they slowly work their way higher. But I mean, looking at things and looking at the presentation I gave, I mean, judging from history, I do think there's a good chance that the gold stocks could probably retest their highs at some point next year, and perhaps by the end of the year break out to new all-time highs. But again, we're a month or so away from the beginning of the year, and there's a lot of things that can happen. But the underlying currents, the underlying economic currents are certainly bullish, because as things get worse, as we know, as things get worse, the economic deflationary forces go stronger and stronger. They have to counteract that with much more money printing.
Yeah.
And last thing, I'll mention a chart, which I'm sure you saw in my presentation, which was from Financial Sense, actually. I should give them credit. But if you look at the amount of debt that was taken on during the financial crisis in 07, 08, it was taken on in short-term instruments, 3, 4, 5, 6, 7-year treasuries or whatever. And not just for the U.S., but for Japan and Europe. All of that debt now is coming due in the next couple of years. It has to be refinanced. So they got to finance the $1 trillion deficits. And on top of that, they have to roll over all of this debt that was taken on during the financial crisis. So to me, that's really the fundamental catalyst that is going to drive the precious metals market into the bubble phase, in the next 3, 4, 5, 6 years or whatever. So looking at that, that's a reason why central banks have to do, I mean, they call it open-ended QE, but you and I know it's permanent QE.
Yeah.
I mean, they're permanently going to have to be monetizing this debt. And so I don't know if that really begins to start in the next couple months, if they're going to do a lot slowly, or if they're not going to do anything for 6 months and then suddenly they're going to print $2 trillion. So it's hard to forecast all that. But I mean, I think investors, they got to hang in there, because with precious metals, you're in the right market, and you just have to be patient. I mean, remember with the tech stocks, nobody knew what the NASDAQ was in the early 90s. I mean, nobody knew what a tech stock was in 1993 or 94. And, I mean, that would have been the ideal time to get into that market. So investors, they have to remember, they have to recall history, and it does take a little bit of time. There's kind of a dead period before that last phase, a wall of worry period, dead period, and that's kind of what we're in now. And hopefully by the end of next year, we can break out of that period.
Jordan, if someone would like to go to your website and subscribe, where do they go?
They can go to thedailygold.com, and they can also email me at jordan@thedailygold.com.
Awesome. Thanks for your time.
Thanks for having me. Really appreciate it.